You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is David Smith. He's the senior analyst for the Morgan Report, which you can find online at silver-investor.com. Last week we talked about the Dotcom syndrome of investment. You said it came in 3 stages. A huge response to it.
It really was. You know, we post many of the interviews that you and I do on David Morgan's YouTube site, and people can go over there. A lot of them have already found it for sure, but they can go over there to youtube.com/user/silver guru. And so the response was really great last week, and it continues this week. I think that people really get the idea that we are going to see a Dotcom Mania type blow-off in the metals at some point down the line, probably within the next few years. And so how we approach that now, when things are relatively quiet, even though volatile in terms of what's historically the norm, will be the opportunity for people to take a modest position after they've done their research and then hang on for the ride.
And you were saying, too, that, what were those 3 stages, though, just to review for the people who may have missed last week's show?
Well, you start out with the early stage where the people that kind of are digging around find values, and it's completely off the radar screen of about 98% of the public. They take position, and you see that first run, which gives them easy money, so to speak. And then you see a consolidation phase where backing and filling and sometimes big drops, which shake out some of the people, and other people take profits and leave. And during that second stage, which we called last week the getting some respect stage, you have new investors coming in, both big and small, and that's what's going on now. We're in that getting respect stage, and we're moving toward an event which I believe will launch the final stage, which will be the end stage where I call everyone in the pool. That leads to the public blow-off where people will pay just about any price that they can for the physical, which will be hard to get with huge premiums, and with the mining stocks as well too. And so we want to position ourselves before that last stage. I don't think that stage is going to get underway until we see a base above $50 on silver and above $2,000 on gold. That's when the light bulbs are really going to start going off, and you'll see the public beginning to pile in over a period of time, leading to the eventual blow-off, where a massive amount of the profits, percentage-wise, as David Morgan has taught a number of years, discussed this, and also we'll be talking about at the Vancouver Investment Conference, January 2021 in Vancouver, the Cambridge House, is that 80 to 90% of the profits of the entire bull move can occur during the last 10% in time of the move.
Wow. So, of course, positioning yourself now and taking a look at the current values of the 2 metals we're talking about, gold and silver. Silver will just ballpark around $32 right now. So there's a $20 gap before you think people are going to hit. You say it's the everybody in the pool stage. I call it panic.
Well, that'll be the beginning of it, and it will develop over a period of time. The panic won't start the moment silver hits $50, but that will be the launching platform for it. People, all of us, have this tendency to they tend to be motivated by prices rising rather than falling. So once it becomes a very obvious fact to everybody that new all-time highs are being established, nominal highs at least, and in the case of silver, the inflation-adjusted high would be 3 times that. But anyway, the nominal high above $50, that's going to bring a lot of people in to look at this and get serious about it. And, we talked mostly about gold and silver last week, and, of course, they're going to be the stars that most people are familiar with. But I have had a special spot always for palladium, which is one of the platinum group metals. You and I have talked about this. We discussed it a lot starting last summer when platinum was about $250, I believe, below the price of an ounce of gold, and that gap has now closed.
I was going to say we made history today. We made history today where that $250 gap between gold and platinum has been closed. So,
right. And,
all the people I was going to say, all the people who listen to you about, there's no way platinum can stay that far below the price of gold. I mean, we were puzzled about why that had taken place, because there's such a demand for it just on an industrial basis. Every vehicle that's classified as a light vehicle needs to have a catalytic converter, and a catalytic converter has 2 precious metals in it, palladium and platinum.
Right, and this situation has been an anomaly for about a year and a half now, because usually platinum is up to $200, $300 an ounce more than gold, but that is now closed. And of course, that can go back and forth. But the interesting thing about platinum, about palladium, I look at it as almost like the relationship between gold and silver. Here we have platinum at about almost $1,700 an ounce, and we have palladium at about $700 an ounce. So there's a 1,000 ounce difference. Palladium can be used in many of the applications that platinum can be used in, and in addition, it's an investor's metal too, even more so than platinum. There have been several different ETFs that either have been formed or in the process of forming, which give investors an opportunity to invest in these metals not directly by having them in their pocket, but through an exchange-traded fund. And the most recent one is Eric Sprott's Platinum and Palladium ETF, and he is a very high visibility player in the silver and gold space, and I think this is going to bring more legitimacy and more visibility to the PGMs going forward.
Now, obviously, somebody is taking a look at the value of these two precious metals, palladium and platinum. The lower mainland area of Vancouver, I should say that's Greater Vancouver, where 2.3 million people live. There's been a rash of catalytic converter thefts from brand new vehicles. The owners of these car lots are coming out and finding that, especially premium pickup trucks, because their catalytic converters are so big to deal with those huge engines, they have a sizable quantity of palladium and platinum in them, and they're disappearing overnight. They said they just walk through their car lot and they'll see bolts laying on the ground beside each one of their brand new, say your Dodge monster truck, I don't know, a Durango, whatever their top of the line pickup is. And they're just going, it's driving them nuts.
Well, this is what you find with any kind of increase in price. It happened with copper. It happened with aluminum. There's always somebody out there that's willing to work to make a dishonest buck rather than try to do what you and I are doing, which is to try to figure out the supply-demand curve and invest either in the physical or in the mining stocks itself. One of the things about palladium is that you can buy it just like you would a gold or silver round. Now, there's a higher premium. I haven't checked recently, but traditionally it's been $50 or $60 an ounce over the spot price of the palladium. So these things can be acquired in the physical sense. You can trade them as ETFs, and you can also buy some of the mining stocks, and there aren't too many, but there are mining stocks that actually either produce the PGMs or are exploration stories that do so as well.
And I'm just wondering too, with these prices going up, who is buying these obviously stolen goods?
Well, it's hard to say. I mean, it's like somebody steals your TV set and sells it, to somebody down the street at a pawn shop or someone that's walking down the street for 10 cents on the dollar. So it ends up in the supply at some point because it has that value. But for us to focus on these things, what I like to think of palladium as a two-doors metal, just like silver. It's got an industrial demand, which is the primary demand, but you have an increasing demand from investors, and this is being really pronounced in China, especially. Not too many years ago, palladium was not a big deal over there in terms of investment, but now you see it being fashioned into jewelry, buying the 1 ounce rounds and buying the ingots. And I think the investor equation is going to continue to increase, and it's going to be a very interesting metal to see how it follows along with gold and silver. It won't necessarily be tracking them identically, but it will, as long as these two remain in the bull trend, I think you'll see the same thing with platinum and palladium.
And looking ahead to the future too, the automotive dealers around the world, their analysts are saying not just this year, but the next 5 years, they expect to be very hot for brand new car sales, and each one of those new cars, again, as we said, are going to be packing some palladium and platinum underneath them to help lower pollution.
We have the massive growth of industrial ownership in China. We have, I could be a year or two off on this, but I think the average age of the car on the road in the United States is around 10 years or so. My car I've been driving it for 11 years. I've got to get a new car in another year or so, or at least a newer car. And so that's that demand factor from the industrial side. Also, there's the same element going on with industrial users that have investors. They can panic and think they can't get the supply and they can start a panic of their own. There was a panic not too many years ago in palladium, which drove the price up to almost $1,100 an ounce from about $150, and it happened in a fairly short period of time. And after that bubble burst, I believe it was Ford Motor Company, they sold their palladium stockpile at about a $1 billion loss. So you don't have to be an uninformed investor to get swept up into a mania. You can be supposedly a sophisticated industrial user and be motivated by the same items of fear of missing out and fear of not being able to get supply.
Right. And, of course, nowadays, you'd look at a big automotive company like Ford, the one big major company that didn't need a bailout. How about that? Obviously, they have some brains behind the company, but even there, they made a mistake by, selling off their palladium because you're going to need it in the future as long as you stay in business. Maybe that was the big question back then for these car companies.
Well, they have to meet quarterly expectations of investors, and it's harder for them to be long-term holders. That's where the advantage of the little guys, so to speak, like you and me come in. We can hold on to these things for a long time if we don't go on margin, and if we keep an eye on the big picture, and if we feel the main trend is still intact, we can just hang in there. And that's what people need to do. They need to keep looking at the big picture, and as long as the secular bull market trend is intact, then they want to consider holding on to their mining shares and their physical for better days ahead.
Right. And again, we know in China, they don't plan for a quarter or 1 year or 5. They always have long-term goals. And I remember a few years ago, the British Prime Minister asking the Chinese Premier, has the Cultural Revolution been a success, or the Chinese Revolution been a success? And he says, well, it's only been 65 years. Give us a chance.
They have a very long-term outlook, and their accumulation of silver and gold and other precious metals continues apace, and they are not going to be dissuaded by a $50 drop in the price of gold. They just buy more of it.
Well, again, we just want to remind folks about the Cambridge House Investment Conference at Canada Place, Sunday the 20th and Monday the 21st. One of the featured guest speakers will be David Morgan, and having worked very closely with David for a long time, his opinion carries a lot of weight in the industry.
It really does. He's always he used to speak, in addition to his keynote speech, he would do a workshop right near the end on the second day, when a lot of people have already left. And his workshops were always packed, even though he was one of the last speakers. And so he speaks at the beginning, and he speaks near the middle, and I'll be there as well, helping at one of the workshops where we talk about how to choose a mining stock so that you end up on the winning team. It's going to be a lot of fun, and I hope people can make it. And if they can't, I hope they'll listen to our discussion today and really do some thinking about how they can not only get involved if they're not, but hang in there on this precious metals bull.
Yeah, and perhaps too, David, you could just give us another tip about when you go to one of these investment conferences, how do you get the most out of it?
Well, I like to go in and get the overall schedule of events and sit down and decide how I want to approach it. There's certain people I'd like to hear, and sometimes there's two speaking at the same time. So what I'll do on that one is I'll try to catch the person for the keynote, and then the other person I'll get for the workshop, and I'll decide which that will be. I go through and I look at the companies. I believe over 600 companies are going to be profiled this time. This is one of the largest investment conferences in the world. It's not uncommon to have 10,000 attendees over a 2-day period. And I choose the companies I'd like to see, and so I have a focused approach to this rather than just going and doing whatever seeks my fancy. So it can be really productive if you lay out your game plan a little bit ahead of time.
My guest is back. Thank you very much, David. Hopefully I'll see you at the conference. My guest has been David Smith. He's the senior analyst for the Morgan Report, which you can find online at silver-investor.com. You're listening to HowStreet.com radio, and you can contact us at info@HowStreet.com. I'm Jim Goddard.